So what is a Gravestone Doji, and how do you recognize it? So a Gravestone Doji is a candle pattern that signals a potential bearish reversal, typically forming at the top of an uptrend. It's got a long upper wick and little to no lower wick, and a small body near the bottom of the candlestick. It can open and close at exactly the same price, or almost. It doesn't have to be exact. The structure shows that buyers initially pushed the prices higher, but by the close, sellers regained control and drove the price back down to the opening level. So how do we recognize it? So regarding the shape, as said, it's a small body at the bottom, and it has a long upper wick, and that's the key. It's got to be long in relation to this small body down here. But if you're questioning, is it long enough? I'm not sure. Well, then it probably isn't. So that's the key. And also little to no lower wick. What it represents is basically the markets rose significantly during the session, but it failed to hold those gains, and it closed coming back down near the open. And the context matters. If it's after an uptrend or at a strong resistance level, that's when you need to be aware. If it's just in a downtrend or just randomly in a sideways market, then it doesn't really mean anything. So that's something to take note of. So how does this actually help traders? Well, it's used to identify potential market reversals and providing insights into possible weakening bullish trends. It's valuable for traders who look for short selling opportunities, or those looking to exit long positions that they're already in before the price starts to decline. You might want to look for this on a time frame above what you're actually trading on. So if you were on the 1 hour chart, you'd probably go up to the 4 hour chart, look for it there, because sometimes these things present themselves on higher time frames and you might not be aware of what's going on if you're just focused solely on the hourly chart. And traders mainly use it for 3 reasons. So they could spot trend reversals, so that it helps them in anticipating a shift from bullish to bearish momentum. The other reason is risk management, so they can place a stop loss above it and use that doji to manage the risk. Or the third reason is confirmation for trades, so they might already be looking for short selling opportunities, and it can act as an early warning sign when they combine it with other indicators. And how do we identify it properly? So to increase its reliability, you want to consider these things. So firstly, it should appear after an uptrend. And remember, everything I'm saying applies also to a dragonfly in the opposite direction. So for the Gravestone Doji, it should appear, it's a bearish signal, it should appear after an uptrend. So let's say you see this price going up and up and up and you see it, that's fine. But if it's going down and you see it, then that would be the wrong context. Or if it appears in a sideways market as well. Second one is it forms at a key resistance level. For me, that's the best one. If the pattern forms at a known resistance zone, a previous high Fibonacci level, it strengthens the case for a potential reversal. It should have confirmation from the next candle. So a bearish candle following the Gravestone Doji, especially one that closes below its low, that can confirm the sellers have taken control. And if you trade volume, the fourth way would be volume should support the reversal. So if there's high volume on a Gravestone Doji or the confirmation candle, then that suggests strong selling pressure. Now here are some common mistakes you might want to avoid or be aware of. So if you trade without confirmation, which is what a lot of traders do, then you're just jumping into a short position immediately after spotting it, not waiting for, say, the bearish confirmation candle. That is quite a big mistake, because even with the confirmation, this strategy isn't perfect. So obviously without any confirmation, it's just not worth trading. Second one would be ignoring the market context. So if it's a choppy and sideways market, there's not much significance there, to be honest. If you overlook key levels, so it's far more effective, like I said, if it forms at resistance, or if it's a dragonfly and it forms at support. And finally, not using a stop loss. Believe it or not, most traders think it's okay to either place a stop loss and move it further away as price gets towards it, which is basically the same as not using one at all, which is also what a lot of traders do. So not using a stop loss is probably just a common mistake in general, but yeah, with this strategy, not using a stop loss, always do use one, and put it above the high of the doji to protect against the failed signal. As you can see here, this would, I mean, looking at it doesn't really look like what we've been talking about, but let's just say that we decided that was a Gravestone Doji because it's got quite a long wick in relation to its body, and then we see it's got the confirmation candle down. We enter, okay, we were wrong. So it does get stopped out. It isn't perfect. Some other reasons that it's not perfect, I'd say not just the false signals, but it can sometimes be a sign of indecision, and it does best work with other indicators. I just use support and resistance. Volume analysis is a good one. Trend lines for confirmation. Any kind of thing that you use as confluence. If you're trading on its own, it's not as reliable as some people say. So just a quick recap. The Gravestone Doji is a bearish candlestick pattern. It's got a long upper wick, small body, little to no lower wick, signaling a bearish reversal. How does it help us? It indicates bullish weakness, possible trend reversal, and it helps spot short opportunities or to exit long trades. To identify it properly, you look for it after an uptrend, forming at key resistance levels. You'd need a bearish confirmation candle afterwards, and if you are watching the volume, higher volume does strengthen the signal. Common mistakes: trading without confirmation, not using a stop loss, remember, and ignoring the market context. Remember, it's not perfect. It can produce false signals. It could sometimes just show indecision. You need other indicators for confirmation.